Joining us now is Bob Iacchino of Path Trading Partners. And Bob, you just heard what President Trump was saying about the Strait of Hormuz. From your perspective, could Iran possibly shut down the Strait of Hormuz, and what would that mean for oil?
Well, without sounding political, it wouldn't be closed for long because President Trump is not, it's not a unilateral opinion. Saudi Arabia would back him up on that. Oman would back him up on that. The UAE would back him up on that. So I agree that it wouldn't be closed for long, although Iran does have the means to do that. So the timing of it, the amount of time it would be closed would be the issue as to whether it would disrupt crude oil in any real way. I think that's where you see the rally that we got today, the rally that we got yesterday, the up 3% or so that we've gotten over the last 2 days. It really leaves the bears still in control, even though we've had essentially a 3.2% rally or a 3% rally this week. You're still looking at a very weak crude oil price, a very oversupplied situation given the potential weakness in demand. If this turns military, there will be a spike, but that spike will slowly ebb away as the supply and demand picture comes into focus.
Bob, are you at all surprised that we didn't see a bigger move to the upside in the price of oil? Because we did see the spike yesterday of around 3%. Prices did move higher today, but they didn't even move as high as 1%.
Yeah, the reason I'm smiling at that question, Sean, is not because of any sort of geopolitical issues. They don't bring me joy, but it's very easy for me to say today that I'm not surprised at it. I did not sell that rally because it's an uncertainty thing. But when you look at it from a perspective of all of the bearish factors that are currently in control, geopolitical clashes between Iran and the rest of the world aren't a long-term worry for the supply of crude oil because Iran would lose that clash very quickly. So you look at it from that perspective, and then you look at OPEC Plus, who has tried to cut. It hasn't worked. They're likely to cut again, but they haven't even announced it. They would have to announce increased cuts. And then you look at the 4-week moving average here in the U.S. Recently went from 12.2 million barrels a day last week to 12.3 million barrels a day, even with the falling rig counts that we've seen the last several weeks. The oversupply is there. And with the global trade tensions, you've got a potentially weakening demand situation starting to take hold in the face of all this excess supply. And lastly, the U.S. isn't even really enforcing the Iranian sanctions to the level that they can. They recently said they were pulling away the exemptions. And then what did we see last week? A decent supply of crude oil go from Iran to India, who's the third largest user of crude oil on the planet and one of Iran's biggest supply or customers rather. So we're not seeing the supply getting taken off the market. And this, I think, falls within President Trump's complaints about where the price of crude oil was headed.
Bob, with oil at right around $52 or just above $52 a barrel, you're saying that the bears are still in control. Where do you see the price of oil trading in the short term?
So it's interesting that I say that, right? And then I say that I'm not selling it here either, because I don't see crude getting much lower than $45, but it's at the midpoint to where I think it should be priced. So its move up to $54, $55 wouldn't surprise me, but that would be a good spot to sell it. I think what we're seeing now is a range. Crude oil bull markets trade up and then range, up and then range. Bear markets, they collapse. We're not in a bear market right now. We're in a recovery from the bull market that we recently had up to that $67 range. So I expect us to go sideways in between, say, a $45 and $54 range. It's a wide range, but if you're trading it, you have to play those ranges as opposed to playing where the price is right now.
Bob, when we talk about the supply and demand issue, what do you think has a bigger impact on the price of oil? Is it a trade war, which triggers the demand concern, or is it Iran, which then triggers supply?
Well, short term, it's Iran, but long term, it's the U.S. supply, because even if they close the straits, the amount of time that they could potentially militarily close it for probably affects about 300,000 to 400,000 barrels of crude oil going through the straits. It only affects Brent. And you notice in the spread between Brent and WTI, that's actually moved up about 6.9% in 3 days, Brent going higher to WTI. Now that can pull WTI up in the face of lower rig counts, which we've been getting, but the supply is still there. The juxtaposition of the rig counts is because of the nature of the shale oil drilling, where the rigs provide an exorbitant amount of crude in the beginning, and then they fall off a cliff. So those rig counts that are deteriorating and coming offline are the ones that aren't producing much crude oil. So in the short term, it's Iran and any actions, but the actions they've taken so far, to me, have been more of like I don't know how to phrase it. You have to pay attention to us. kind of a message, as opposed to we're going to actually close the straits. The economy of Iran is in a really bad spot right now. To close those straits, I think, is a desperation move, a Hail Mary. I don't think they're at that point yet.
All right, Bob Iacchino of Path Trading Partners, thanks for joining me today.
Good to be here, Shauna.